You know, when a geopolitical crisis hits the news, what's the first thing most people do? They panic. But here's the thing. Experienced investors, they see something totally different. They see a predictable pattern, and honestly, a massive opportunity. Today, we're going to pull back the curtain on the exact playbook they use to navigate all that market chaos.
This quote right here, it just gets right to the heart of it. While all of our attention is glued to the explosions on TV, to the headlines, that fear, it's a distraction. The real action, the thing that's actually going to impact your wealth for years to come, is happening quietly, behind the scenes, in the financial system. And that right there is the secret. While the whole world is watching the news, smart money isn't focused on the conflict itself. Nope, they are focused on the predictable, almost automatic policy response that comes from governments and central banks. Why? Because that response follows the same script every single time.
So, to really understand the professional's move, we first have to look at the amateur's playbook, which is really just a list of traps. These are the emotional, knee-jerk reactions that can absolutely destroy a portfolio during a crisis. Okay, trap number 1, and it's the most common by far: fleeing to cash. I get it. It feels safe, doesn't it? But it's not. If we just assume a pretty standard 3% inflation rate, holding cash for 10 years could mean losing almost half, 45%, of your money's actual value. So in an attempt to avoid a temporary market loss, you've accidentally signed up for a slow but guaranteed one. The second trap, chasing the obvious play, oil. When people see conflict in the Middle East, their brains scream, buy oil stocks. But history shows us this isn't a strategy at all. It's a pure gamble. See, the price spikes on the fear and the uncertainty, not always on the actual reality of the event itself. And hey, look at the 1991 Gulf War. It's a perfect example. Oil spiked all the way to $46 a barrel based purely on panic. But on the very first day the war actually started, it dropped by $10. Any investor who bought into that fear got absolutely wrecked. The pros? They were the ones selling into that panic, not buying it. So if we avoid those traps, what do we do instead? Well, we use the professional's playbook. And this isn't about emotion or guesswork. It's all about anticipating that predictable government response with a strategy that's driven by data. And this brings us right to the core of the pro's playbook. It's a predictable 3-step process. In pretty much every major crisis, governments and central banks do these 3 things to stabilize the system. They inject liquidity, which just means they make money cheaper and a whole lot more plentiful. Oh, and they're always giving it some new confusing name to avoid spooking the public. It used to be quantitative easing, now it's reserve management purchases. Honestly, it doesn't matter what they call it. The effect is exactly the same. More money flows into the system, and that money, well, it has to go somewhere. This is exactly why, when you look at the actual data, war doesn't cause a long-term market crash. It causes a temporary dip, an emotional pullback. And for investors who understand the game, that dip is a massive, massive buying opportunity. And here's the proof. Over the last 50 years, investors who had the discipline to buy the S&P 500 during a war-related dip saw an average gain of 15.4% over the next 12 months. The historical data is crystal clear. You buy the fear, you don't sell it. Okay, so we've established why we should be buying, not selling. Now for the fun part. Let's talk about what to actually buy. It's time to build a strategic portfolio that's designed to both weather the storm and capture all that upside. So, a professional's crisis portfolio, it isn't about making one single bet. Think of it more like a diversified machine, where every single part has a very specific job to do. You've got your insurance, you've got your direct play on the conflict itself, and then you've got your long-term growth engine. Let's break it down like this. Gold is your defensive insurance policy. Defense stocks are your offense. They directly benefit from all that government spending. And tech is your long-term home run, where you can buy world-class companies at a serious discount. Look, gold isn't about getting rich quick. It's about not getting poor. It is your hedge against all of that money printing we just talked about. I mean, it's what the central banks themselves are buying. A lot of pros now recommend having a 10 to 15% allocation here, just as a foundational piece of your portfolio. Next up, defense. Now, this isn't a moral judgment, it's a financial reality. When conflicts happen, government spending on defense skyrockets.
Companies like RTX have backlogs. We're talking over $250 billion that is guaranteed revenue for years and years to come, which makes it an incredibly powerful and direct play.
And here is the most counterintuitive part of the whole strategy. Tech stocks get hammered by fear, but the market is just a voting machine in the short term, right? In the long term, it's a weighing machine. This panic gives you the chance to buy the fundamentally strongest companies, the ones that are going to lead the next decade of growth at a discount. But listen, having the right assets is only half the battle. The other half, and frankly the more important half, is having the psychological discipline to actually execute your strategy while everyone else around you is completely panicking. This is where discipline becomes absolutely critical. You have to make your selling decisions when you are calm and rational, not in the heat of the moment. So before you buy a single share, you define your exit plan. You know exactly when you'll sell for a profit, and you know exactly when you'll sell for a small managed loss. This is completely non-negotiable. And you don't have to perfectly time the bottom. There's a powerful tool called dollar cost averaging that lets you systematically buy into a declining market. You just invest a fixed amount at regular intervals. This lowers your average cost, and it takes all the emotion out of trying to be a hero. Finally, here's maybe the single most practical piece of advice I can give you. The news is not your friend. It is an emotional manipulation machine, literally engineered to make you fearful and irrational. The best investors protect their mindset by just tuning out all that noise. And you know, it all comes back to this one core idea. If you take away just a single lesson from all of this, let it be this one. Learn to see past the noise of the crisis itself. The signal, that predictable, repeatable policy response, that's where the real opportunity lies. That's where you should be focusing your attention and your capital.
So I'll just leave you with this question. A crisis? It feels like destruction, right? But when you really understand the mechanics, you realize it's often just a massive transfer of wealth, from the fearful to the prepared. The only question left is, which side are you going to be on?